Hello and welcome to MonsterInvest. I'm Daniel, and I'm so glad you've decided to join me here today. We are about to take a journey. It's a journey into a world that, for many people, feels like a dark, intimidating forest, a place full of confusing maps, strange languages, and whispered rumors of treasure guarded by fearsome monsters. That world is the stock market. When you hear that phrase, the stock market, what's the first thing that comes to your mind? Is it a chaotic trading floor with people in suits shouting and waving paper? Is it a constant, stressful stream of red and green numbers flashing across a TV screen? Or maybe it's just a feeling of anxiety, a feeling that it's a club you're not a part of, a game you don't know the rules to, a place where you could lose everything. If any of that sounds familiar, I want you to take a deep breath. You are in exactly the right place. My mission today is not to make you a Wall Street trader. It's not to teach you how to get rich overnight. And by the way, if anyone ever promises you that, you should run in the other direction. My mission today is to be your guide, to walk into that forest with you, holding a lantern. We're going to tell a story, and in that story, we will find that the monsters are usually just shadows. We're going to learn the language. We're going to demystify the jargon, and by the end of our time together, you will have a solid, confident foundation. This is stock market basics, what every beginner should know. So let's start at the very beginning, with the most fundamental piece of the puzzle. What exactly is a stock? I want you to forget the flashing numbers, forget the charts. I want you to picture a business. It can be any business, but let's imagine your favorite local coffee shop. We'll call it Sarah's Amazing Coffee Corner. Sarah makes the best latte in town. She's been in business for 5 years and she has a loyal following. She saved her money, she's profitable, and now she has a dream. She wants to expand. She wants to open 2 new locations in other parts of the city. She does the math. To build out those 2 new shops, buy the equipment, hire the staff, sign the leases, she needs $100,000. She has a few options. She could go to a bank and get a loan, but the interest rates are high and she doesn't want to be that in debt, so she decides to do something else. She decides to sell pieces of her company to the public. She decides to go public. She sits down with her accountant, and they decide that her entire business, her brand, her recipe, her profits, her existing shop, is worth, say, $400,000. She wants to raise $100,000, so she decides to sell 20% of her company. Her accountant helps her divide that 20% ownership into 10,000 tiny, equal pieces. Each one of these pieces is a share of stock. Now you love her coffee. You go there every day. You've seen how busy she is, you believe in her dream, and you believe in her ability to succeed. You hear that Sarah is selling these shares to raise money. You decide you want to support her, and in the process, hopefully, share in her future success. So you buy 100 of those shares. Let's say each share costs $10. You give her $1,000. What just happened? You just gave Sarah the capital, the money she needs to grow her business, and in exchange, she gave you a certificate of ownership. You are no longer just a customer. You are a shareholder. You are an investor. You are a part owner of Sarah's Amazing Coffee Corner. That is all a stock is. It is not a lottery ticket. It is not a magical piece of paper. It is a tiny, fractional piece of ownership in a real-life, breathing, operating business that sells real products or services to real people. When you buy a share of Apple, you are becoming a part owner of the company that makes the iPhone. When you buy a share of Coca-Cola, you are a part owner of the company that makes that fizzy drink. It is as simple and as profound as that. Okay, so that's a stock, but where did you go to buy it? And what happens a year from now if you decide you want to sell it? You can't just walk into the coffee shop and ask for your money back from the barista. You need a place where all the people who own shares of Sarah's company can meet all the people who want to buy shares of Sarah's company. You need a central, organized, fair, and regulated place to make that transaction. That is the stock market. Think of it as a giant global farmers market, or maybe a giant eBay for businesses. It's not one physical building anymore. It's a vast electronic network. Places like the New York Stock Exchange, the NYSE, or the NASDAQ are the exchanges. They are the marketplaces. They connect millions of buyers and sellers from all over the world every single second. And how is the price set? It's a beautiful, simple auction. It's pure supply and demand. If at this very moment there are more people who want to buy Sarah's stock than want to sell it, the price will get bid up. Someone will say, "I'll pay $10.01. Another will say, "I'll pay $10.05. The price rises. If there are more sellers than buyers, maybe some bad news came out and people are scared, they will compete to sell. Someone will say, "I'll sell mine for $9.99. Another will say, "I'll sell for $9.90. The price falls. When you hear on the news, the market was up today, it is a very simple statement. It just means that, on average, across thousands of companies, there were more buyers than sellers, and the collective value of those companies, as decided by all of us, went up. So now we know what a stock is and where we trade it. The next big question is, why? Why would you take your hard-earned money and buy one of these shares? What's in it for you? This is the most important part. There are two primary ways you can make money, or to use the proper term, build wealth, by investing in stocks. The first way is the one everybody thinks about, capital gains. This is the buy low, sell high story. Let's go back to Sarah. It's been 3 years, and your bet on her paid off. She used that $100,000, she opened her 2 new shops, and they are a massive success. Her little company isn't just a local shop anymore, it's a recognized citywide brand. Her profits have tripled. The whole company, which was worth $500,000, is now worth $5 million. Your tiny piece of ownership has grown with it. That share you bought for $10. Because the company is so much more valuable, people are now willing to pay $100 for that same share. If you decide to sell your 100 shares, you would get $10,000. You invested $1,000 and you made a profit, a capital gain of $9,000. Not bad, right? You shared in her success. That's the first way. You invest in a company that you believe will grow and become more valuable over time. But there is a second way to make money, and this way is a favorite of long-term, patient investors. It's called dividends. Let's imagine a different path for Sarah. Let's say 15 years have passed. Her company is no longer a fast-growing startup. She has her 3 shops, they are very successful, but she's not expanding anymore. She's running a mature, stable, profitable business. Every 3 months, the company has extra cash. It's made more money than it needs to operate. What does it do with that profit? The company's board of directors, which, as a shareholder, you helped vote for, decides to share that profit directly with its owners. They declare a dividend. They take a portion of the company's profits and just give it to you, as a thank you for being an owner. It's a check that gets deposited in your account. It's like getting a little piece of the company's earnings, every single quarter, just for holding on to the stock. Now, not all companies pay dividends. Many young, fast-growing tech companies will take all of their profits and reinvest them back into the company to grow even faster. They are focused 100% on capital gains. But large, stable, mature companies, think utility companies or big banks or classic brands like Procter & Gamble, are famous for paying dividends. It's a way to reward investors for their long-term loyalty. So you can make money when the price goes up, or you can get paid just for holding the stock, and in many of the best investments, you get both. Okay, this all sounds wonderful. We buy pieces of great companies, they grow in value, they send us checks in the mail. What's the catch? This is MonsterInvest. We have to talk about the monster, and the monster is risk. There is one single, unbreakable, non-negotiable rule of investing, and it is this: you are not guaranteed to make money. In fact, you could lose some, or all, of your money. The stock market is not a savings account. When you put money in a savings account at the bank, it is insured, it is safe, it is guaranteed. And in exchange for that total safety, the bank pays you almost nothing. In fact, with inflation, you are probably losing purchasing power. An investment is, by definition, an exchange of safety for the potential of higher growth. You are taking a risk. What kind of risk? Let's go back to Sarah's coffee corner. What if her new locations were a disaster? What if she opened them in a bad neighborhood and nobody came? What if a giant, global coffee chain opened a store right across the street from all 3 of her shops and drove her out of business? What if, after 3 years, Sarah's company went bankrupt? That share you paid $10 for, it's now worth 0. Your $1,000 investment is gone. This is called company-specific risk. It's the risk that the one company you invested in simply fails. But there's another, bigger risk. What if Sarah's business was doing fine, but the entire economy went into a deep recession? People lose their jobs. They stop buying $5 lattes and just make coffee at home. It's not Sarah's fault, but her profits, and the profits of almost every company, go down. In this scenario, the entire stock market, the value of all companies, might fall. This is market risk. And then there's the third risk, the one that lives inside all of us, emotional risk. The stock market is a machine that is fueled by 2 powerful, primal human emotions: greed and fear. When prices are going up, people get greedy. They see their neighbors getting rich. They feel FOMO, the fear of missing out. They buy, often at the very top, when prices are most expensive. When prices are going down, people get terrified. They see the value of their life savings shrinking. They panic. They sell, often at the very bottom, locking in their losses. This is the cycle that destroys most beginner investors. They buy high out of greed and sell low out of fear. So this is the challenge. We now know that in this forest there is real treasure, the power of capital gains and dividends. But there are also real monsters: the risk of failure, the risk of a recession, and the risk of our own panic. How do we, as smart investors, tame these monsters? How do we get the treasure without getting eaten? We do it with two of the most powerful and time-tested principles in all of finance. The first principle is diversification. You have all heard the phrase, don't put all your eggs in one basket. This is the single most important piece of investment advice you will ever receive. Let's create two new hypothetical investors. We'll call them Tom and Jane. Tom has $10,000 to invest. He does a ton of research, and he decides that Sarah's Amazing Coffee Corner is the best company in the world. He is 100% certain it will be a success. He takes his entire $10,000 and buys shares in that one single company. He has put all his eggs in the coffee basket. Jane also has $10,000. She also likes Sarah's coffee, so she takes $500 and buys some shares. But then she takes another $500 and buys stock in a big, stable tech company, and another $500 and buys a healthcare company, and another $500 for a bank, and another for an energy company. She spreads her $10,000 across 20 different companies in 10 different industries. Now, let's play out our nightmare scenario. The global coffee bean fungus hits. Sarah's company goes bankrupt. What happens to Tom? He's wiped out. He's lost everything. His entire $10,000 is gone. What happens to Jane? She's not happy. She's annoyed. She lost the $500 she invested in the coffee shop. But what happened to her other 19 investments? That same year, it turns out, her tech stock doubled. Her healthcare stock went up 30%. The gains from her other investments completely wiped out the loss from the coffee shop. In fact, her total portfolio of $10,000 probably still grew to $11,000 or $12,000. That is diversification. It is the art of spreading your risks so thin that the failure of any one part cannot destroy the whole. It is your number one shield against company-specific risk. But what about that market risk? What about when everything seems to be falling? This is where our second principle comes in, and it's even more powerful. It is time. The stock market is volatile. That's a fancy word for it jumps around a lot. In the short term, any one day, any one week, any one month, it is completely unpredictable. It's chaos. It's a random walk. People who try to time the market, who try to guess the perfect day to buy and the perfect day to sell, are not investing. They are gambling. Let's invent two more friends, Ben and Lucy. Ben is a market timer. He's always on his phone checking the news. He hears a rumor, so he buys. A bad headline comes out, he panics and sells. He's trying to jump in and jump out. He's stressed, he's anxious. And the data shows that, over and over, people who do this miss the best days. So much of the market's long-term gains happen in just a few unpredictable, explosive days. If you're on the sidelines, you miss them. Now let's look at Lucy. Lucy is boring. She buys her investments and then she goes on with her life. She reads a book. She takes a walk. She knows that in the short term, the market is a voting machine driven by fear and greed. But in the long term, it's a weighing machine. It weighs the true value, the true profits, the true innovation of the underlying businesses. If you look at a chart of the stock market for any one day, it looks like an earthquake. If you look at a chart of the stock market for the last 80 years, it is a line that goes, with some very scary dips from the bottom left to the top right. Why? Because over the long run, humanity innovates. We get better at things. We invent medicine. We build computers. We create new services. The economy as a whole grows. When you invest for the long term, you are not betting on a squiggly line. You are betting on human ingenuity. And time does something else. It unlocks the most powerful force in the financial universe, compounding. This is the magic. Compounding is simply your money making money, and then that money that you just earned starting to make its own money. It's a snowball. The first year, your investment makes a little bit of profit. The next year, you're earning profit on your original investment plus the profit from the first year. The snowball is a little bigger. It rolls a little faster. After 30 or 40 years, that snowball is an avalanche. This is how true wealth is built. Not by gambling, not by hot tips, but by patiently letting your diversified investments compound, year after year after year. Okay, deep breaths. We've covered a lot. We know what stocks are. We know what the market is. We know the risks. And we know our two biggest weapons against those risks, diversification and time. So what's the last step? How do I actually start? This all sounds great, Daniel, but I am not an expert. I can't research 20 different companies. I don't know how to pick a tech stock versus a healthcare stock. That still sounds like way too much work. You are 100% correct, and the beautiful thing is you don't have to. For almost every single beginner, the best way to start is not by picking individual stocks. Picking individual stocks is hard. You are competing against people who do this for a living, 80 hours a week with supercomputers. As a beginner, it's a tough game to win. So what's the alternative? Remember our friend Jane, who built a portfolio of 20 different stocks. What if you could buy that entire portfolio, all in one click, for one low price? You can. It's called a fund. And the most popular, simple, and powerful type for a beginner is called an index fund. An index fund is a beautiful, simple invention. It is a bundle that is designed to automatically buy and hold a basket of stocks that tracks a specific index or list. The most famous one is an S&P 500 index fund. The S&P 500 is just a list of the 500 largest, most profitable companies in the United States. When you buy one share of an S&P 500 index fund, you are not buying one company. You are instantly, automatically becoming a part owner of Apple, Microsoft, Amazon, Google, Johnson & Johnson, Berkshire Hathaway, and 494 other massive companies. You are instantly, automatically diversified. You are no longer betting on Sarah's Coffee Corner. You are betting on the entire American economy, all at once. For most people, that is a much safer, smarter, and more powerful bet to make. And how do you actually buy this fund? You do it through something called a brokerage account. This is the last piece. Think of a broker as simply the store or the platform that gives you access to the stock market. There are many different firms that offer these accounts. The key is to find one that is reputable, available in your country, and has low fees. You open an account, you transfer money into it, just like a regular bank account, and from there you can buy your investments. And when you search for an S&P 500 index fund, you'll often find them listed as ETFs, or exchange-traded funds. This just means it's a fund that you can buy and sell easily. You don't need to know them all, but you'll see them represented by ticker symbols. For example, some of the largest and most popular ETFs that track the S&P 500 have symbols like VOO, IVV, or SPY. By purchasing a single share of one of these, you are instantly buying a tiny piece of all 500 companies. And then you wait. You let diversification protect you. You let time and compounding build your wealth. That's it. That's the whole game. It's not as complicated as they want you to believe. So before we go, let's just run back and summarize the key lessons we've learned on our journey today. First, we learned that a stock is not a lottery ticket. It is a simple, real share of ownership in a real business. Second, the stock market is not a casino. It is a giant, global marketplace that connects buyers and sellers to determine the price of those shares based on supply, demand, and real-world performance. Third, we learned that you build wealth in two ways: capital gains, the price of your shares going up, and dividends, the company sharing its profits with you. Fourth, we looked the monster of risk right in the eye. We learned that you can lose money, and that the biggest risks are company failure, market downturns, and our own emotions of greed and fear. Fifth, we learned how to tame those monsters. We use diversification, so no single failure can wipe us out. And we use time to ride out the short-term chaos and let the power of long-term economic growth and compounding do the heavy lifting. And finally, we learned that for most people, the simplest and most powerful way to start this journey is to open a brokerage account and buy a low-cost, diversified index fund, like an S&P 500 fund. You have just taken the most important step. You have armed yourself with knowledge. That intimidating dark forest, it's just a collection of trees. The monster, it's an engine for growth, and you now understand how it works. You don't need to be a guru. You don't need to check the market every day. You just need to be patient, disciplined, and consistent. You just need to be an owner, not a gambler. If you want to continue learning with us and join a community of investors who are taming their financial monsters, please help support the channel. Go ahead and hit that like button, share this episode with a friend who you think needs to hear this, and be sure to subscribe so you never miss what's next. This is Daniel from MonsterInvest. Thank you for walking with me today. The journey has just begun, and I'm excited to see where you go. Keep learning, keep building, and I'll talk to you next time.